Seattle, once the crown jewel of the Pacific Northwest housing boom, may finally be running out of luck. Home prices that defied gravity through 2025 now face the perfect storm heading into 2026. Rising debt, falling affordability, and a national forecast warning that over 600 markets could slide by next spring. Is Seattle next? This video breaks down what's happening beneath the surface of Seattle's real estate engine, and the warning signs most reports aren't saying out loud. We'll look at 5 clues: mortgage stress, affordability collapse, tech sector risk, inventory shifts, and national contagion. Stay to the end for a simple rule of thumb that shows when the market actually tips. According to Narada Real Estate, analysts expect Seattle prices to show moderate growth through 2026. They cite tech employment and limited supply as stabilizers. But moderate is market speak for fragile. If even one variable, like rates or job growth, breaks, those forecasts collapse fast. The Madrona Group reports a 30-year fixed rate around 6.37% in mid-2025. Even a half-point uptick to about 6.9% can price out thousands of buyers overnight. Households are already at record debt-to-income ratios. That means Seattle's buying power is shrinking every month, even if salaries stay flat. HousingWire's June 2025 update showed affordability in Seattle at its worst level in over a decade. Listings are creeping up, but prices aren't falling yet. That's classic late-cycle behavior. When buyers can't afford to act and sellers refuse to drop prices, volume dies first, then prices follow. Seattle's market runs on tech money. But as companies freeze hiring or trim remote work benefits, the buyer pool thins. Office vacancies downtown remain above pre-pandemic levels, and stock option wealth, the fuel for condo buyers, is volatile. If the NASDAQ stumbles, Seattle housing feels it within weeks. Madrona lists Seattle inventory at 2.9 months. Tight, but that number hides a shift. New construction permits are down, yet existing homes are quietly stacking up in suburbs like Kent and Everett. Once that shadow inventory hits the market, the price floor can vanish fast. Narada's national alert predicts more than 600 metros could see price declines by April 2026. If national sentiment turns bearish, buyers hesitate, even in markets that still look healthy. Seattle may not lead the crash, but it rarely escapes it either. Every cycle has a moment when confidence breaks. For Seattle, watch this ratio: median home price to median income. When it exceeds 10 to 1 and rates stay above 6%, historically that's when corrections start. Today, Seattle sits around 9.8 to 1. One more rate hike and we're there. So will Seattle's housing market crash in 2026? No one can time it, but the conditions are lined up: mortgage stress, shrinking affordability, tech slowdowns, and national contagion. For buyers and sellers, the smart move is preparation, not panic. Subscribe for monthly Washington market updates.